Hello and welcome to our most recent urgent market update for Thursday, the 19th of September. You're probably very aware, last night we saw a very significant rate cut from what was quite a dovish Fed. We'll break that down for you in a little bit more detail, and we'll have a look at how the markets initially react to that particular event and where markets are likely to go over the course of the trading day so far. So we wanted to give the opportunity for these markets to just identify which direction they're looking to move in before we can make some assumptions about where markets go from here. So let's get straight into it then. Okay, so the title of this short video is Big Rate Cut from a Dovish Fed, but how will markets react? So let's get straight into it then. We'll of course start, as we always do, with our risk warning. Just take a brief moment to familiarize yourself with our risk warning currently up on screen. And let's start with having a look at this news event yesterday evening. So let's bring up Forex Factory. So we're going to last night's FOMC, and there was an expectation. The expectation up until about a week ago was very much around a 25 basis point rate cut, but there was a lot of whispers and rumors around this particular event, which meant that a 50 basis point rate cut was more and more in the pipeline, and that's the way it turned out. And not just was it a 50%, quite a large rate cut up front, you're kind of front loading that particular narrative. We also had quite a dovish Jerome Powell, in our opinion. So the upshot is we've really lowered rates by 50 basis points to save off, any sort of recessionary fears, to ensure we get this soft landing, to maintain a slightly lower focus on unemployment rate, help out the economy a bit. Everything is performing well, and we don't really need rates up to 5.5, so bringing them down to 50 is a good first step. So the question was always not so much whether it's 25 or 50, it was more about the projected potential rate cuts and what does that mean? Are they cutting because we've got a recession, or are they cutting because inflation's back close to 2%, and they don't really have any fears on the recession, on the inflation side of things. And although Jerome Powell said, no, we've not claimed victory against inflation, it can come back and things of that nature. But if you look at the decisions that the Fed have made, that's exactly what they're saying. They're saying we don't have any concern on the inflation side. Everything on the surface seems to be relatively pointing to lower inflation, so we can bring those rates down without inflation re-emerging. So at this point, let's show you the initial market reaction to this particular news event. So what did the markets do initially? Well, perhaps we'll look at the S&P 500 on the left. We've got the Dow Jones in the middle, and we've also got gold on the right-hand side as well. So let's just change this to the daily time frame. So interesting to see a little bit of additional volatility in the Dow Jones just since we started this this broadcast. So let's go into the S&P 500 as a good proxy, really, for the broader reaction to this particular news event, and we can look at it on the daily time frame. So this was the starting point going into that rate decision. We saw an immediate spike to all-time highs, but then we saw prices start to roll back over to the downside, running into strong support levels. And then overnight, we started to see a bit of a potential rally, and now we've got not just one structural failure, but two structural failures with prices coming back into this low. So this is actually getting close to a bit of a buying opportunity now. And as we're looking at this on an hourly time frame in a live chart. So what we can say from this price action is that if we just remove the volatility around such an important news event, then we can quite clearly see that the sentiment is very positive. Lowering interest rates has a net benefit for corporates, corporate balance sheets. It means not just for corporates, but also for the balance sheet of the government. When they come to refinance debt, they'll be doing so at lower rates, and for individual households. And that has a net stimulative effect, very much expected on these equity markets. And that's pretty much what we're seeing. Now, the only thing that could become a bit of a problem for this very, very bullish sort of market dynamic is if the data don't really support that strengthening economy. So if there's inbuilt weakness, if unemployment numbers start to rise, if inflation starts to come back stronger, then that would effectively be a very sort of worrying development for these markets. So with that in mind, our bias is very much to the upside and very likely to be over the shorter term. So we're looking for good high probability trading opportunities to the upside across the equity space. And you'll have to just cherry pick where the better opportunities perhaps will lie. Probably at this point, in terms of answering the question behind this particular urgent market update video, is how will the markets react? Well, not only have we seen a bit of a positive reaction, a net positive reaction, if I can just share this slide with you perhaps, we really are expecting further risk on market dynamics to come from this. So the reasons for this risk on dynamic is very much around a very dovish Fed narrative, with the lowering of interest rates, the practical lowering of interest rates. The expectation now is that inflation will continue to make progress to the downside. There is still this belief from the Fed that they are remaining restrictive enough to keep that inflation number lower. They're expecting the unemployment rate to stabilize around 4.2, maybe sort of get up to 4.4, but that's within the realms of flexibility. They're certainly gambling on that soft landing narrative. They think the economy is okay. Broadly, things are relatively positive, and we'll be looking very carefully for that positive economic data, and as it's released. And this is around growth. It's around inflation. It's around unemployment. It's around retail sales. It's around these very important indicators now. And if they are of a positive nature, then we'd probably expect this risk-on narrative to continue. And don't forget, we've still got this AI tech rally still ticking away in the background. That may come to the fore in a few weeks' time when we start getting corporate earnings through. So for now, in terms of market narrative, we're very much focused on this risk-on narrative. We have been for, over the last number of weeks, and we've seen some big moves as far as the indices are concerned. But that's really where our focus lies. It's looking for indices to continue making progress to the upside. Now, if we're at all-time highs, we're looking for a pullback. That's the current phase that we're in now. So we're looking for further upside, but we do need to get that technical pullback so we can get into those trades. The dollar, we do expect over the short to medium term to continue to weaken. Those bond yields, that's the next part to the question, is what are the bond yields doing? Well, we're currently at lower levels. This is the 2-year. This is what the Fed have the biggest impact over, would be the 2-year Treasury yields. And we've rolled over from 5 to 3.6, and we're just sitting around that sort of 3.6 level. A little bit up, a little bit down, but not a huge move. If we look on the further down the curve, we can see more of a pronounced bit of a short-term rally. but we're still, we've still made some very, very significant progress. And these bond yields just give the opportunity for the Fed to continue to cut rates over the coming meetings, and we'll see if that's the case. Now, the last thing that feeds into this narrative is, what are the big seven doing? They're having a profound, these micro markets are having such a profound impact on the macro, and that still hasn't really changed. So what are they doing? Well, they've just all pretty much gapped to the upside. So Nvidia, we were looking quite bearish yesterday. Today, now we've gapped up considerably higher. And it's that same narrative pretty much across most of these markets. If I just share a few, very important tech stocks, we've gapped higher. A little bit of selling has just creeped in over the last literally few minutes. But we've seen a sizable gap to the upside in Amazon. I'll just do a few more. If we have a look at Apple, very close to all-time highs. And we've actually seen a new all-time high in Facebook. So a bit of positivity feeding through. Where's Facebook? Yeah, Meta. So so interesting. We've gapped and we've seen a new all-time high for Meta and Facebook. And on the open, it looks like we're just turning a little bit bearish. So that's going to be an interesting development. What that will do is give us an opportunity to buy the indices perhaps at slightly better prices, as in lower prices. So we're really waiting for that pullback to start to kick in. So an upside move finally in Tesla after the last couple of months have just been really focused on weakness. Now we're just making that progress to the upside. So will we see a little bit of a bounce across many of these tech stocks? It certainly looks as if that's the case. Big gap up from Microsoft, and then some selling has begun to kick in. So we're going to have to watch these dynamics and see how they play out very, very carefully. But in terms of a narrative, we're really focused on this risk-on dynamic with indices higher and a weaker dollar. So going back to the S&P 500, we'll have a look at these trades where across major markets, whether it's indices, whether it's gold, okay, we're kind of pulling back a little bit off the highs, but all that does is give us an opportunity to perhaps start buying a decent pullback in these trades. Looking at the dollar in a bit more detail, a little bit more indecision, I think is probably the takeaway, and we're going to be hearing from the Bank of Japan tomorrow, so we'll get a further update as far as the yen's concerned. And the last one is really crude oil. With what's going on in the Middle East, with the supply cuts from OPEC, we were able to book in profit today on a bit of a bounce off the lows. We're running into strong resistance around that $71, $72 level, and that looks to be the case so far, but we'll be watching these very, very carefully. So to conclude, if I can just bring this, if I can bring this back up on screen. Sorry, bear with me 1 second. So, yeah, so here we go. All right, so so how will markets react? Well, they've already reacted in a pretty significant manner, and our expectation is to see further upside, further risk on dynamics, those indices to continue making progress, the dollar to continue to weaken. We broadly expect those bond yields to, if not make new lows, just certainly sit at those bottom levels. And we do have quite a bullish view on commodity markets as well because of that weaker dollar. So we're very hopeful we'll get a series of decent trades. We're very comfortable looking for buying opportunities in these markets, even though we're up at all-time highs. So look, that just about concludes this urgent market update video. We hope you found it useful to some degree. Of course, we're very mindful of the fact that we do have a really dovish Fed. They decided collectively, apart from one disdainer, to actually cut by 50 basis points. So that's pretty comprehensive. It's pretty dovish. And although the initial reaction was very erratic, we're now certainly looking for the benefits of loosening financial conditions to feed through these in-sea markets. So hopefully this all makes a little bit of sense. So you may have questions about anything covered. If so, do feel free to drop us an email at support@thelivetrading.com, and we will hopefully get back to you as soon as we possibly can on that. And apart from that, all that's left for me to say really is to thank you for joining us for this short video. Do stay tuned for our next video. And if you are interested in learning how to trade the financial markets, you can access one of our live trading and education bundles on our website. Just starts at $59 per calendar month. For more information, just go to thelivetrading.com, and do feel free to connect with us through our website if you need. Great stuff. On that note, listen, thanks for joining us. We'll see you next time. Bye for now.